Good morning, everyone. Thank you for joining us today for our session. I can see participants are still joining us. Zoom's just letting more people in. So we're going to get started here in the next minute or two. But really appreciate everyone joining us. Hope everyone had a wonderful long weekend. My name is Robert Lemon. I'm one of the audit partners on the governmental side, do a lot with the government industry line, and I'm just going to be moderating today. And I think we've got a really good session. Deferred inflows and outflows have been kind of a mystery to a lot of people, and certainly a cause of confusion to a lot of people since GASB kind of introduced them. And we are so lucky to have a bit of a specialist with us who's put together some fantastic content. Two specialists really who've both put together fantastic content for everyone today. This subject is worth me mentioning. This subject of deferrals. We're going to do more than just a webinar. We are putting together, because it is such a mystery, such a unique thing that has caused problems for people. We're putting together a webinar, an article, various other things to really try and explain this subject and give people the tools to understand and no longer be confused or mystified by deferrals. So that's something to look out for that we're going to be providing. But it looks like everyone's trickled in now. Zoom has let everybody in. So we are going to get into the slides here and get rolling with this session. So let's go to the next slide. I'm still seeing the title. Okay. A few little housekeeping items before we get into the good content. CPE is obviously available for this session. Everyone attending will receive 2 CPE credits, provided they stay on for the full duration of the course, and also complete 80% of the polling questions. You do not need to get your polling questions correct, but you do need to answer them in order to get credit. So just submitting answers is what's required to at least 80% of the questions. And as I said, be on for the full duration, as well as being logged in with your own unique link. If you want your own credit, you have to be logged in with your own unique link that you will have received. We typically send out the CPE certificates within about a week. They'll be received via email. And if you do, you'll get them from our marketing team at prolera.com. That's support@prolera.com address. Look out for those. And our marketing team are available. Their email address is there, marketing@cricpa.com. If you have any questions on certifications, marketing will be happy to help. They do a terrific job putting this webinar on, so I want to thank them now for doing all the work and making it run so smoothly. So last bullet point there, you'll see PDF handouts of this presentation. They should be available through the Zoom chat. So if you want the download of the slides via PDF, those are in the chat. I will say as well that the raise hand function isn't an option on this. If you want to communicate with us, type it into the Q&A. I'll be addressing questions as and when throughout the session, or if it's something that I think is worth kind of saving till the end and discussing with everyone, I'll do that one at the end of the session. So if you've got questions, please pop those into the Q&A. All right, well, let's move through. And here are your 2 fantastic presenters today. Anyone who's attended these CRI governmental sessions is probably very familiar with Becky Hammond, terrific presenter and really a high-level technical expert. She's a partner out of our New Orleans office in Louisiana. So we're very lucky to have her today. She's going to add some really good content to the subject of deferrals. So she'll be one of our presenters, along with Dean Mead. Again, anyone who's attended a lot of our governmental sessions knows Dean. We are very, very lucky to have Dean. I'm going to make him blush. Luckily, his camera, I think, is off, so he's probably blushing because he's just such a terrific presenter and such an asset for CRI. He had almost 25 years almost working with the GASB, and he was very high-level technical expert on GASB subjects. So he's put together a lot of our content and really knows this subject. So he's a fantastic presenter. And there's me, as I said at the beginning, my name's Robert Lemon. I work with the governmental industry line and have been a partner doing governmental audits for quite a while, done my fair share of those. So enough about me. Let's get to the real brains. I'll just go through the agenda and then I'll pass it over to Dean. So what we're going to cover today, as I said, it's all about the deferrals, the deferred inflows and outflows. Dean's able to give us some unique insights into the background and also then give a really good description of the definitions of these items, why they're important. Dean has some fantastic content on that. And Becky's going to be providing practical examples throughout. We'll do a deeper deferral dive of what's waiting for the right period, and then a deep dive. There may not be a right period. So that's a couple of interesting chapters of this session today we've got put together. Understanding deferral information in the financial statements. Then, as I mentioned earlier, we're going to have a number of resources from CRI. So there'll be a session just explaining the resources we're going to be providing on deferrals. And then we'll wrap up with our summary and Q&A. So interesting stuff there. Before we do actually send it over to Dean, let's get started with a polling question, which I'll launch here. So polling question number 1, let me click to launch this for everyone. Let's read it out. So this is just to get a feel for how you feel on deferrals. How would you describe your understanding of deferrals? Do you understand them very well? Do you understand some things about deferrals? I understand relatively little. Or what are deferrals? So we're going to give everyone a chance to get their answers in just quickly on this one. We do, as I say, we do require that you answer 80% of the polling questions. There is no right answer for this, but correct answers are not required. Just get your answers in. We're mostly voted now, so let's get these last few answers in, make sure everyone gets credit. And then Dean, I believe you're kicking us off right today. Dean, it's over to you after this question.
That's correct.
Excellent, and I hope you didn't blush too much, but you really do have a fantastic amount of knowledge on this subject, and I just appreciate all that you've put together here on this content. So thank you very much.
Thank you, Rob. You're very kind.
All right, we got 95% answered. Of participants have answered. Last couple of seconds here, and I'm going to shut this down. And so if you do want your CPE credit, get your answers in now. Going once, going twice. Okay, ending the polling question. Oh, so we just got an answer in. And then I'll share the results. Dean, most people say they understand some things about deferrals, so it's a pretty good starting point. Over to you, Dean.
Thank you, Rob. Good morning, everybody. I'm going to start with the centerpiece of the webinar to try and help you understand a little bit better what deferrals are and where they come from before Becky starts the process of going through some of the specific deferrals that governments are required to report and what those look like and how they show up in the financial statements. Starting from the beginning, there comes a time, I think, in every young government accountant's life when their parents sit them down to have the talk, to explain to their young accountants where deferrals come from. Most people, I think, are probably familiar with GASB statements, which contain the requirements that governments follow when they're preparing their annual audited financial statements, but they might not be as familiar with GASB concept statements, which actually contain requirements for the GASB itself to help ensure that it sets accounting and financial reporting standards consistently over time. And that's where deferrals began. That's where their life began in governmental accounting. It was in concept statement number 4, which the GASB worked on through much of the early 2000s and issued in 2007. Concept statement 4 established definitions for the things that are reported in the 2 types of financial statements that governments generally present. One of those, statements of financial position, tell you where a government stands financially as of the end of the fiscal year, and they report 5 elements: assets, liabilities, deferred inflows of resources, deferred outflows of resources, and initially net assets, but now called net position. And the other kinds of financial statements are resource flow statements, which tell you how a government performed financially over the course of the fiscal year. And they report 2 types of items: inflows of resources, most often as revenues, and outflows of resources, most often as expenses or expenditures. Now, some people claim that the GASB just created deferrals out of thin air. And I was there at the time. I can tell you that a lot of work went into it. There really was no magic involved at all. It's true that GASB came up with the names, which is something I'll get back to, because they are a part of the confusion, I think, that a lot of governments have with a lot of people have with respect to deferrals. But these things that GASB labeled as deferrals already existed, but they were being called by other names. Primarily, they were being referred to as assets or liabilities. The problem is that they didn't meet the definitions of assets or liabilities or any of the other financial statement elements that people were most familiar with. So what GASB did was look at every item that was then required to be reported in government financial statements and compared them with the definitions of assets, liabilities, inflows of resources, and outflows of resources. And they ended up finding quite a few items that didn't meet any of those definitions. Perhaps the most notorious of those was an item in the governmental fund financial statements referred to as deferred revenue. Deferred revenue, as it used to be reported in the governmental funds statement of revenues, expenditures, and changes in fund balances, was actually, not in the governmental funds balance sheet, was actually a combination of both liabilities and future revenues. So it included some liabilities like unearned income or grants that are received before eligibility requirements have been met. Both of those represent money that a government received in advance before it provided a good or service or before it met the eligibility requirements for the grant. And they are liabilities because the government, if it doesn't provide the good or service to the customer, or it doesn't meet the eligibility requirements set by the grantor, then it has to give them the money back. Those things are appropriately liabilities. But in addition to those liabilities, that thing called deferred revenue also included unavailable revenue, which is the part of expected revenue in the governmental funds that was not collected during the year or shortly thereafter, and therefore wasn't available to pay for that year's expenditures. That's not a liability. That's not an amount that governments owe to anyone else. Deferred revenue may also have included future revenues, such as property taxes that were levied for the next fiscal year. That also is not an amount that is owed to anybody else. It's not a liability. So this one item that was being reported as a liability in the governmental fund financial statements actually may have only a small portion of it may have been a liability, and the rest of it wasn't a liability at all. So when GASB first proposed that concept statement, most of the elements that it identified were a surprise to no one. Assets were defined as resources with present service capacity that the government presently controls, which means stuff that it owns, that it can use to provide services, that produce income to provide services, that can be sold to produce income that can be used to finance services. Liabilities were defined as present obligations to sacrifice resources that a government has little or no discretion to avoid. In plain language, these are amounts that the government owes to others. Outflows of resources were a consumption or a using up of net assets by a government that is applicable to the reporting period, generally the fiscal year. Net assets being the difference between assets and liabilities, or essentially the governmental version of net worth. And then inflows of resources were an acquisition or an obtaining of net assets by the government that was applicable to the fiscal year. The two things that Gatsby proposed in the proposed version of concept statement 4 that surprised a lot of people were deferred outflows of resources and deferred inflows of resources. And if you compare those to the two definitions we just looked at of outflows and resources and inflows of resources, the difference is that deferred outflows of resources are consumptions or using up of net assets that are applicable to a future reporting period. And deferred inflows of resources are an acquisition or an obtaining of net assets applicable to a future reporting period. If you compare that with the definitions of outflows of resources and inflows of resources, the word isn't there, but you could just as well stick in there current, that those are related to the current reporting period, whereas deferred outflows and deferred inflows are related to a future period. So I told you I'd come back to the name. The names of those two elements, deferred inflows of resources and deferred outflows of resources, are no small part of the confusion that people have, because they seem to imply that it's the inflow or the outflow of the resources that has been postponed, but that's not true. That's not what makes them different from things that are reported as revenues or expenses or expenditures, because they're inflows of resources or outflows of resources related to the current period. In both instances, resources have flowed into the government or resources have flowed out of the government to another person or another entity. But in the case of the deferrals, that inflow or outflow isn't related to the period in which it happened. It's related to a future period. So it's not that the inflow or outflow is deferred, it's the reporting of them as revenues or expenses or expenditures that is put off until the proper future period. In other words, recognition of revenues, expenses, or expenditures is deferred until an appropriate future period. It's not the inflow or the outflow. That has already occurred. So if you're saying, what? Can you repeat that, Dean? I can. And I'll say it again and again as many times as is necessary. That's the primary purpose of this webinar, Demystifying Deferrals. If we leave here and you don't have a better understanding of what they are and where they came from, we won't have done our job. So it's not the inflow or the outflow of the resources that is postponed. In both instances, they've occurred. The government's received cash or a promise to pay. It has paid cash or made a promise to pay someone else. And in most of the cases, that's going to be related to the current period. But for deferrals, in relatively rarer instances, those inflows or outflows are related to a future period. And in that future period, that's when they're going to be recognized as revenues, expenses, or expenditures. So most deferrals are eventually going to be reported as revenue or expense or expenditure when you get to the period that they belong to, which is why I like to call them revenues waiting to happen or expenses waiting to happen, waiting for their moment to shine. When you get to that year, they're going to be reported as revenue. But in the meantime, they're kept on the balance sheet or the statement of net position as deferrals until that period arrives. And then in some cases, in a couple of cases, the deferrals may never be reported as revenue or expense or expenditure because they either largely offset one another or because they're related to items that begin and end with no value over the life of the transaction. And I'm going to say a lot more about that as we move forward. So when an inflow of resources occur, a government receives cash or it receives a promise to pay or some other resource, most of the time it's related to the period that it was received in, and it gets reported as an asset, a cash or an account receivable, and as revenue in that period. If, however, it's related to a future period, you report the cash or the promise, the account receivable, and instead of revenue, the government initially reports a deferred inflow. And it continues to report that deferred inflow until that future period that the flow was related to arrives. And at that point, it gets rid of the deferred inflow, and then it reports that inflow as revenue. And on the flip side, if a government pays cash or it makes a promise to pay, the vast majority of the time, it's related to the period that it happened in, the current period, and it gets recognized as a reduction in assets. For instance, they don't have as much cash as they had before, or an increase in liabilities because now they have an account payable that they didn't have before. And they also report expenses and or expenditures depending upon which financial statements you're looking at. On the occasion that that outflow of resources is related not to the current period, but to a future period, the government's going to recognize the reduction in assets or the increase in liabilities, but it's going to report a deferred outflow rather than expense or expenditure until that future period arrives. And at that point, the deferred outflow goes away, and the government will then report the expense and or expenditure. So I'm going to let that sink in for a second while Rob joins us again and asks us poll question number 2.
Thank you, Dean. Okay, I'll launch this one, then I shall read it. Okay, polling question 2 has been launched. This one asks, which of the following statements is true about deferred inflows? Is it they are resource inflows related to the current period, they are expenses waiting to happen, they are resource inflows related to a future period, or none of the above? So we're getting answers in pretty nice and quickly here, but keep them coming. And that was a great introduction, Dean. Thank you for that.
You're welcome. And while we're waiting for everyone to answer, I can't speak for everybody who was on the board of the staff of the GASB in 2007, but personally, I regret the decision to name the deferrals the way that we did in Concept Statement 4. Hindsight's a wonderful thing. And in hindsight, it's hard to imagine that whatever confusion there might have been that the board was trying to avoid in terms of people associating these new items with what was called deferred revenue before. It's hard to imagine that that would have been nearly as bad as the confusion that we've actually had as a result of naming them deferred outflows of resources and deferred inflows of resources. So not that I was running that project or really had much say over it at the time, but if I could go back and do it over, I think calling these things deferred revenues and deferred expenses or deferred expenditures probably would have been the less confusing option.
Hey, but that's why we're lucky to have you here today, Dean, to clear up any confusion and to set everything straight. But we are getting pretty good responses here on the polling question. I think we're at 95%. Almost everyone's answered. So I'm just going to give it a few more seconds. So if you want your CPE credit, get your answer in. And again, you don't need to get it correct, but I'm gonna wrap this up here. Going once, going twice. All right, I'm ending the poll. And I will share the results. Dean, there's the results. And
79% of the respondents got the answer right. You don't have to get the answer right. Just remember, you just need to answer. It's the first answer isn't right because a deferred inflow is related to a future period. The second isn't right because a deferred inflow would be a revenue waiting to happen rather than an expense waiting to happen. So hopefully what we talked about before taking a break with that polling question has started to sink in. So let's go through it just one more time. If you're like me, it's helpful to see things even with very simple pictures and it helps me to grasp things that maybe I didn't grasp just looking at it in words. So a government receives cash or a promise to pay. So you ask, does it relate to the current period in which it was received or to a future period? And if it relates to the current period, the government's going to report revenue. And if it relates to a future period, it's going to report a deferred inflow until that future period arrives. And at that point, it's going to report the inflow as revenue. And on the other side, when a government gives cash or a promise to pay, the same question, does it relate to the current period in which it was given or to a future period? And if it relates to the current period, which it most often will, the government is going to report expense or expenditure, depending upon which financial statement you're looking at. And if it's related to a future period, it will temporarily report a deferred outflow until that future period arrives. And at that point, get rid of the deferred outflow and report expense and or expenditure in that future period. Now, I'm sure many of you are very astute, and you might look at that, what we've talked about up to this point, and say, those deferred outflows sound an awful lot like a prepaid asset, like prepaid rent or prepaid insurance, payments made in advance of receiving the goods or services from the provider. And it is true that, like a deferred outflow or prepaid asset, ultimately will be reduced over time when the related expense is reported as the insurance company or the rental company earns their payments over time. But whereas a prepaid asset has service capacity, it's an asset, a deferred outflow doesn't have service capacity. It can't be used to provide service. It doesn't generate income that can be used to finance the provision of goods and services. It's not something that can be sold to produce income. It doesn't have any of the qualities of an asset. And that's why it doesn't meet the definition of an asset, and GASB requires it to be reported separately. Similarly, you might look at deferred inflows and say, that sounds a lot like what I understand to be unearned income. The government's received money, but it hasn't yet provided the good or service that it's supposed to provide in return for that payment. And like a deferred inflow, unearned income ultimately is going to be reduced as the related revenue is reported. And that will happen when the government actually earns the payment by providing the good or service. So whereas an unearned income is a liability, if the government never provides that good or service, it's going to have to pay the customer back. A deferred inflow is not an obligation of any sort. It is no requirement for the government to pay any amount of money to any other entity or any person. It doesn't mature like debt. It doesn't require any resources in order to be satisfied. It doesn't meet any of the criteria to be considered a liability, and that's what makes it different from unearned income. So hopefully up to this point, you have a little bit better understanding of what deferrals are, how they're different from current period revenues and expenses or expenditures. But you still may be saying, but was it necessary? Did it absolutely have to happen? And my answer is yes. Quite apart from the fact that those things clearly are not assets and liabilities, despite the fact that they used to be reported with the assets and liabilities, deferrals serve at least two really important purposes in governmental accounting and financial reporting. One of those is that they are essential to recognizing revenues, expenses, and expenditures in the right period. An important objective of financial reporting by state and local governments that is unique to state and local governments and distinguishes them from other types of entities and their objectives for reporting to the public about their finances is that there is an expectation that governments will live within their means from year to year. They'll raise enough money every year to cover that year's costs. That concept in the accounting literature is referred to as interperiod equity. And deferrals make it possible, or at least enhance the ability of the user of the financial statements to assess whether a government is making ends meet, whether it's living within its means from year to year. And the other really important thing that deferrals help with is not only making sure that revenues, expenses, and expenditures are reported in the correct periods, but in the correct amounts. Certain deferrals relate to inflows and outflows of resources that may never provide resources to the government, may never require the government to sacrifice resources and provide them to another entity or to an individual. And the importance of these types of deferrals is that they avoid overstating or understating revenues, expenses, or expenditures in any given period. And now, over the next several slides, as Becky and I go through some of the examples of the most common types of deferrals that governments are required to report, most of them will fall into this first category of making sure that revenues and expenses are reported in the right periods. But we'll also talk about some that are intended to also make sure that revenues and expenses and expenditures aren't stated in amounts that are higher or lower than is reflective of the government's acquisition of resources or its relinquishing of resources. And that brings us to poll question number 3, Rob.
Thanks, Dean. I'll go ahead and launch this one. Polling question 3 should be coming up now, and then I'll read this one out. So number 3 asks, what did the GASB find when it reviewed the items being reported in financial statements? Is it A, that items among the assets that did not meet the definition of an asset, items among the liabilities that did not meet the definition of a liability, items among the liabilities that were on aggregation of an aggregation of liabilities and non-liabilities, or all of the above? Now, I've sat a few of these sessions before, and typically in all of the above is a strong option here. So I think a lot of people.
Come on now, Rob.
I know. Well, most people have got their answers in, and they seem to be aware of that option. But I think you gave a softer question here, Dean.
Yeah. Well, while the last few are straggling in, just say something about this concept of interperiod equity. I think even if you aren't familiar with the term, you probably realize how pervasive this is in the governmental sector, where there generally isn't a profit motive, but we do expect governments to operate efficiently and effectively, and to pay for their goods and services when they're provided. I think we generally expect that a government's going to raise enough resources each year in order to pay for that year's costs, rather than eating up its savings or pushing costs off to the future. But it doesn't always mean that you're going to report the cost right away. And I think an example of that is, if a government is constructing or purchasing a school building or building a bridge that it can use for many years to provide services, you probably know that the cost of those capital assets is reported incrementally, over the period that the government is using that asset to provide services to the public. And so interperiod equity doesn't necessarily mean every cost is financed immediately, but that the costs related to each year are paid for that year and not pushed off to future taxpayers, unless the taxpayers are benefiting from it, as they do in the case of a school building or a bridge.
Yeah, it's a really good example. And I'm going to wrap this up here for people still waiting to get their answers in. We're pretty fully responded, so going once, going twice. I'm ending the poll, sharing the results, and I think I alluded to this, Dean. A lot of people guessing.
I'm sure they all would have gotten it right without your enormous hint.
I think so. So I'll stop sharing. Back to you, Dean.
All right, I'm going to do one last slide, and then I'm going to turn things over to Becky because I'm sure you're all tired of hearing my voice. This is a list of the deferrals that governments are currently required to report as appropriate, if they're related to their particular situation and their types of transactions. The ones in the left-hand box are the ones that we're going to provide examples of because they are relatively more common than the ones on the right-hand side. So revenue recognition in governmental funds, that's the unavailable revenue that we talked about earlier. There are several deferrals related to pensions and retiree health insurance or OPEB, other post-employment benefits. Gains and losses related to refinancing outstanding debt are reported as deferrals. Property taxes levied in advance are an example of the future revenues that we talked about before. Governments just adopted the lease standards, and those standards require reporting of a deferred inflow when governments are lessors. Grant money that's received that can't be used until a future period, but that otherwise have no remaining eligibility requirements result in deferrals. And then probably the least common of all of these in the left-hand column are transactions that are called derivative instruments, which we'll talk about and I'll explain a little bit, enough to make your hair hurt, but not so much that it makes your hair fall out, and why governments enter into those and what the nature of those deferrals are. And I'm not going to go through each of the ones on the right-hand side other than to point out that if you're a college or university, then irrevocable split interest agreements are probably common in that area. Public-private and public-public partnerships, or P3s, and service concession arrangements, or SCAs, are becoming more prevalent over time. And I suspect that if we did this presentation again in 5 or 10 years, that might move over into the left-hand side column as being at least as common as hedging derivative instruments. And then certain other things like asset retirement obligations and sales of future revenues aren't very common, but when governments do engage in those transactions, there are deferrals that they're required to report. So I'm going to turn it over now to Becky, and she's going to start walking you through some of the actual examples of deferrals that governments report.
Thanks so much, Dean. That was such a great presentation on the basics. I think I see it all the time. Our clients really just have a hard time understanding these concepts. They're definitely a little more complicated than I think the GASB intended them to be from the beginning. So we're happy to help bridge the gap here. Most types of deferrals will be reported eventually as a revenue or an expense or expenditure, depending on what type of fund they're in. These deferrals really are just waiting to happen. And when the appropriate period is reached, we will be replacing that deferral with a revenue or expense, as Dean said earlier. One of the most common is property taxes. We see this in most municipalities and several other types of governments as well, if the municipalities pass on any of those property taxes to those other governments. And so a common deferral with property taxes is when a tax is levied, the levy is passed in a period prior to the end of the fiscal year. And then the government does a billing or has an enforceable legal claim for that levy before year end and collects some of those taxes. This creates a deferred inflow situation that needs to be reported as such. And this will then have us report revenue and eliminate the deferred inflow in the subsequent fiscal year. This can be a little confusing because what I've seen in practice is some municipalities will levy the tax for the current fiscal year, and some will levy the tax for the next fiscal year, and each of those situations has to be handled differently. So, I always say just make sure that you understand which of those circumstances it is, because the accounting for that is different. Another common area that has deferred possibilities is grants. Most of the time, your grants have program expenditures that meet the eligibility requirement. We report a receivable and a revenue. We submit that paperwork to the grantor approves it, and then we receive the money, we report a cash and remove the receivable. Less often, we get the money ahead of time. We report a cash and a liability. We then expend those program expenditures and meet our eligibility requirements. We report that revenue and remove the liability, submit our paperwork, and the grantor approves what we did on the back end. And even much less often, we get grantor approval on the front end. We receive the money with a time restriction, which creates cash that we have to report along with a deferred inflow. The time restriction passes, we report revenue and remove the deferral, and then we have the expenditures to recognize along with it. So this is just you see these grants with time restrictions a lot more often in nonprofit type situations, but occasionally we will see these in governmental entities as well. In governmental funds, revenue is reported when resources are received during the year or soon enough afterward to be used to fund that year's expenditures. That's our expenditure matching with our resources. If a portion of our money coming in will not be received until after the period of availability, that's our 60-day rule, then it's reported as a deferred inflow. So this is our unavailable revenues example. Most common one in this case is property taxes, where if our year end is December 31st, 2023, any property tax receipts that we receive within 60 days after year end is going to be counted as 2023 revenue if they were levied in 2023. Anything received after that is a deferred inflow as a 2023 for that 2023 levy year. So that creates that deferred inflow situation. In the grant situation, if an entity meets the eligibility requirements for the various grants that it has throughout the year, the state is notified, but sometimes it takes a long time to disperse the grants funds back. If the entity's policy for the state grants is that same 60-day rule, then you're also going to have a deferred inflow situation. Now, I will say I've seen different rules here. Some entities have as much as a 6-month rule. That's not as common. Most do the 60-day rule situation here. But property taxes and grants are the most common unavailable revenue examples that I can give you. The big thing to realize here is that anything that's recognized as a deferred inflow as of the previous year, so if I recognize a deferred inflow for this unavailable revenue in 2023, it's going to be unavailable revenue from it's going to be revenue in 2024. Same thing. If I had a previous year's unavailable revenue in 2022, it's going to be revenue in 2023. So it will always turn in the next year. And now we'll turn it back over to Rob for a poll question.
Okay, number 4, launching polling question number 4. Excuse me. This one asks, in what financial statement is the deferred inflow unavailable revenue, in quotes, reported? So in what financial statement is the deferred inflow unavailable revenue reported? Is it the government-wide statement of net position? Is it the budgetary comparison statement? Is it the proprietary funds statement of fund net position, or governmental funds balance sheet? So get your answers in. This one's a bit more tricky than the last, so I'm giving no clues on this one.
Becky, you mentioned briefly the example with the intergovernmental grants using the 60-day period of availability, and that you've seen some governments that have used longer periods, like 6 months. I've actually seen a few that used a period of availability for intergovernmental grants of a year. The example we used, because it was 60 days, if it were a longer period, the likelihood that there would be a deferred inflow for unavailable revenue would decrease, because the government would be extending the period beyond the end of the fiscal year, during which it would consider monies that came in to be this period's revenue.
Exactly. Yeah, it gets tricky, especially when if they maintain their 60-day rule for property taxes, but then have a different rule for grants. The accounting can get pretty tricky with that, but it's a policy decision with each government.
Yeah, it certainly is tricky. That's why I'm glad we're doing this session, and we're getting good responses to this polling question here. I'm going to give people a few more moments. So if you're thinking and just trying to figure it out, let's go ahead and get that answer in to make sure you get your CPE. Again, you don't need to get it correct. Just need to submit an answer for your credit. So last few seconds, best to get an answer in here. I'm going to wrap it up. So going once, going twice, final call for answers, and I'm ending the poll. All right. Sharing the results with you there, Becky.
Yeah, so the correct answer was governmental funds balance sheet. Because if you remember, we had just talked about how the 60-day rule turns in the next year. It also turns on the government-wide statement as well, because remember, government-wide statements represent full accrual basis accounting, which means that this concept of unavailable revenue isn't recognized the same way. So that's why you're only going to see unavailable revenues on the governmental funds balance sheet and not on the government-wide statement in that position. So I think we tried to trick them there, Dean.
I wasn't trying to be tricky. Since we were talking about governmental funds, but to follow up on what you just said, governments in their full accrual financial statements are going to recognize the entire amount of the property tax that's considered to be collectible as revenue. And then a subset of that is recognized as revenue in the governmental funds, because there's this additional requirement that it be collected during the year or within that 60-day period after the end of the year. So if they expect to collect it, but not until beyond that 60-day period, there are certain amounts that are reported as revenue in the government-wide statements that are not reported as revenue in the governmental funds. And that's where this deferred inflow comes into play.
Yep. So we also have examples that require accounting over multiple years. Some common ones are the new GASB 87 on leases, service concession arrangements, sales of future revenues, those irrevocable split interest agreements that Dean mentioned earlier. And these payments are recorded at or before the agreement commences, but they have to be basically spread across the time period. And immediately reporting that revenue or expense would basically skew the financial statements and affect the ability to assess that interperiod equity that Dean talked about earlier. So in order not to overstate the initial year, we have to make sure that we are spreading that. So in this example, government signs a 10-year agreement that starts the next year, and they receive an upfront payment of $10 million. So there's that $10 million payment at the beginning. And then they would then get, is that another payment?
Yeah, I'm sorry, Becky. So that we were, what I was doing here was laying out the, trying to answer this question at the top of when is it appropriate to recognize that upfront payment at $10 million, eventually driving to the point that you've been making, which is the most appropriate thing to do is to report that upfront payment as it's being earned over the course of the 10-year agreement and not upfront.
Absolutely. So because it is a 10-year agreement and there are, responsibilities associated with that agreement that span across the 10 years, you would then, need to recognize that accordingly across the 10-year period. And so you defer on the front end, the whole 10 million and amortize it down over the course of the period. Same thing with leases. If we have a 5-year lease starting January 1st of 2023, we're going to record, and this is on a lessor arrangement. We're going to record a lease receivable and an offsetting deferred inflow of resources at the commencement of the lease. And then each year report revenue and reduce our deferred inflow of resources by a systematic and rational amount across those 5 years. For service concession arrangements, for an entity involving a new or improved facility, the new facility is, or the improvement is recorded as a capital asset. There's a lot offsetting liability for any contractual obligations to the operator, and that creates a deferred inflow for the difference between the two. And then for any upfront or installment payments from the operator, you're going to have either a cash or if there's a receivable related to anything due that's stipulated in the agreement, then any liability for any obligations to the operator that also can create a deferred inflow for any differential. So it's just good to know these things. For both of these, you're reporting revenue and then reducing the deferral over the term of the service concession arrangement. Some examples of service concession arrangements, just because it's such an interesting title that a lot of folks don't realize what this means, but it's whenever you have an agreement for someone outside, they often call it privatizing, where you have someone else operating your water treatment plant, your tunnel, your bridge, your airport, often telecommunication networks, different facilities, things like that. Most often see it with bridges and airports and I think water treatment facilities. And time for another poll question.
Okay, thank you very much. Let's launch number 5. So polling question number 5 asks, which of the following is not a transaction for which the GASB requires governments to report as a deferral? So which is not required to be a deferral? Is it a lease in which the government is lessor? Is it prepaying for insurance? Is it sale of future revenues? Or is it service concession arrangements? So which is not required to be a deferral? Again, no hints from me on this one, Dean. I'm going to be good.
Well,
Thanks,
as you
Rob.
said, we don't, no one needs to get the answer right. I think we dropped a couple of hints along the way that should help to answer this question.
Yep, and I see answers are coming in fairly quickly. So let's get everyone's answers in, please. Now, Dean, we have had a couple of items come into the Q&A. Not sure if you want to take a look at those, perhaps type in an answer or answer live if you prefer at the next polling question. But
sure. Well, let me take care of one of these right away. There's a question about just asking for to explain why the property taxes levied in advance of their fiscal year are not the same thing as unearned revenue. Unearned revenue, and property taxes levied in advance. In both cases, the government, may be in a position to recognize an asset, cash or a receivable, but it doesn't recognize revenue in either case. In the first case with unearned revenue, the reason it doesn't recognize revenue is because the government hasn't provided the good or service it's being paid for. And it's not until it actually provides the good or service that it can recognize revenue. And until then, it recognizes a liability that reflects the fact that if it doesn't provide the good or service it was paid for, it's going to have to give that money back to the customer. Whereas for property taxes levied in advance, that's not an amount that the government would ever have to give back to anybody. It is recognized as a deferred inflow of resources because it's next year's property taxes. So you don't, even though the government may be entitled to payment now, before the fiscal year has started, you don't want to recognize any of that as revenue until the fiscal year that it relates to, say July 1 arrives. And at that point, you get rid of the deferred inflow for property taxes levied in advance, and you recognize the property tax revenues in the appropriate year, the year for which they were levied, not the year in which they were levied, which in this example is this year rather than next year. And I'll get to the other question that's up here in the next poll question.
Perfect. Thanks so much, Dean. All right, last chance to get your answers in. Going once, going twice. I'm going to end the poll and share these results. Looks like people did pretty well, mostly.
Yeah, not too bad. 55% said prepaying for insurance, and that was the correct answer. Remember that prepaying for insurance is actually a prepaid asset, not a deferral. The other items were all items that we listed as deferrals. So another common example is in our debt refundings, especially when we have this situation, which is where we have a city that had 15 million of outstanding bonds with 20 years remaining until they were paid off. The city refunded those bonds, issuing 14 million of 20-year bonds at a lower interest rate. So this obviously created an economic gain of $1 million, which is that outstanding amount of the old bonds minus the amount needed to pay them off, less their fees. So the city is going to report a gain as a deferred inflow, and that inflow is going to be which reduces the city's interest expense over. They're going to then recognize this as interest expense over the shorter of the remaining life of the old bonds or the new bonds. So In this case, we've got a 20-year period. We're removing the old $15 million of bonds, adding the new $14 million of bonds, and we've got this $1 million of difference. We're going to deduct from interest expense $50,000 per year, which is $1 million divided by 20. In this case, it was easy because we had 20 years left to pay on the old bonds, and the new bonds were 20 years as well. If the new bonds had been a smaller period, we would have went with the smaller period. If the amount needed to pay off the old bonds was $16 million, there would have been a $1 million economic loss. We would have gone the opposite way, and we would have had a deferred outflow instead. And we would have added interest expense and reduced the deferral by $50K per year. So in this case, with debt refundings, you can create either a deferred outflow or inflow. And you can see examples of this either way, because even though you might have an economic gain or loss one way or the other, often there's a cash flow reason for doing these types of transactions. All right, pension and OPEB. I really think this is the area that I think causes the most confusion, especially amongst our clients. And in fact, I think this is the area I do the most work in the consulting arena with helping to provide calculations, and where I get the most questions from other accounting firms in my area. Because there's so many different types of deferrals related to pension and OPEB. So the amount of pension and OPEB expenses a government reports each year is derived from the increases and decreases in the related liability. Those changes result from various factors, such as if there's new benefits for the year, any interest, any changes in assumptions that were used to measure the liability that the actuarial valuation contains, and any differences between those assumptions and actual experience. The GASB standards view pension and OPEB as transactions between governments and their employees that extend over an employee's career, rather than just as new transactions each year. So based on that, certain factors cause increases and decreases in these liabilities, are initially deferred and then reported as expenses over multiple years. So you can see there's a lot of them, but basically there's three that get recognized immediately. Those are any normal costs, interest, and any changes in benefit terms. So if you have those, that gets recognized immediately. You're not going to defer that. The next section in blue is items that get recognized and expensed over the average remaining service period of all the plan members. So this is that situation where we're waiting for the right period to recognize them. And those have to do with changes in assumptions, differences between the expected and actual economic and demographic factors, any differences between the expected and actual proportionate share of the contribution. So when you have a cost sharing plan where you're having to calculate proportionate share, that is going to change. Proportionate share and what actually took place from the contributions perspective is always going to be different. And then the actual change in the proportion itself is going to be different. Any differences between the projected and actual earnings on plan investments are always amortized over a closed 5-year period. And that's also going to be amortized net, whereas the previous items were not net. And then finally, any contributions after the measurement date basically are always going to be recognized in the next periods, and will reduce the next period's liability. So here's just an example of the footnote disclosure that shows some real examples. The items that are boxed in blue are those items that are recognized over the average service life of the plan members. And as you can see, there's both an outflow and an inflow in each of those. And that's because they're not reported net. The item in the middle is your net difference between the projected and actual earnings. That's your investment, interest earnings. And that is net. You will see that either as an outflow or an inflow, but not both. And then the last item, the contribution subsequent to measurement date, will always be a deferred outflow. And the only reason you won't have that item on here is if the measurement date and the reporting date are the same. So in order to basically show how this all factors out over the multiple years and how you're going to recognize this expense over the remaining years, as you can see, this has the reporting requirement is the next 5 years in individual increments, and then thereafter. You can see that each of these amounts are different. They're not the same in each year. And that's because these items are layered on top of each other. Each year that we have new deferrals creates a new set of layers. And those layers are going to move over 1 year, which creates that differential in total amount of deferrals. And then each year you're going to recognize the portion from that year that's being amortized for that layer. So versus earlier where we just had basically one layer, with pension and OPEB, we have multiple layers. And this is a large part of what causes so much of the confusion with the calculations and where a lot of the errors in that I see in this arena with the accounting is because these layers just cause a lot of confusion, and it's a lot of complicated accounting. All right, well, I'm going to turn it back over to Dean.
Thank you, Becky. So earlier when I was talking about why deferrals are important, we talked about two things. One is getting the expenses, expenditures, and revenues in the right period, and the other was getting them in the right amounts. So these last two deferrals that I'm going to talk about are the latter kind, where they may not be a right period to recognize revenue or expense or expenditure, related to that deferral. It may be that they will cancel one another out over time, and that either no revenue or expense or expenditure gets reported, or a reduced amount gets reported because they do offset over time. One of those relates to derivative instruments. The other is the one item that Becky didn't cover related to pensions and OPEB, and that is the difference between projected investment income and actual investment income in each year. And the point of these deferrals are to make sure that revenues and expenses that are never going to be realized as resources that the government can use, or resources that it's going to have to give to somebody else, to make sure that they're not reported as revenues or expenses, and only those that are going to be realized like that are reported as revenues and expenses. So the first example is hedging derivative instruments, and I am not going to get into the specifics of derivative instruments, which I'm sure all of you will take as a blessing, but I will say enough so that you can understand the nature of this deferral. So some governments will enter into these transactions called derivative instruments for the purpose of protecting themselves against the risk of loss, of losing asset value or of losing cash flows. So for instance, a very common type is an interest rate swap. A government issues debt that is variable rate debt. So it's like a variable rate mortgage. Over time, based on market conditions, the interest rate that you're paying to the lender, in this case, the purchasers of municipal debt, may go up or down as the interest rates go up or down. And so a government may, in addition to entering into this, issuing this variable rate debt, will also enter into a companion derivative instrument to protect itself from rising interest rates, so that if interest rates do go up, that this derivative instrument transaction will cap the amount that they have to pay and essentially turn the debt into fixed rate debt, so that they're always paying the same amount no matter what happens to the interest rate on the variable rate debt over time. So they're hedging the risk. They're protecting themselves against the risk, which is why this is called a hedging derivative instrument. And as long as that hedging derivative instrument continues to largely or entirely offset the changes in fair value or the changes in cash flows of the related transaction, those annual increases and decreases in the derivative instrument's fair value are reported as deferrals rather than as expenses. So if you were to look at the course of say a 6-year derivative instrument, it begins with no fair value at all. It ends with no fair value at all if it reaches its full expected maturity of 6 years. But in the interim, its value may rise and fall depending upon what happens in the markets and what's happening with that related debt in the example that we were talking about with the variable rate debt. And as long as the fair value of the derivative instrument is positive, it is reported, that amount is reported as a deferred inflow. If it is negative, it's reported as a deferred outflow. And so you can see in this case, it starts initially, there's an increase in the fair value. The fair value declines in the second year, but it's still positive, so it's still a deferred inflow. And then by the third year, it's now a negative number. It's gone into a liability position, so that if this were to end right now, the government would be in a position where it would have to pay the other party to the transaction. And as long as it's in year 3, year 4, where it's in this negative value position, it's a deferred outflow, but then the fair value of the derivative instrument rises again before ending in year 6. And the point of this is, you can see that it had no value to start with, it had no value to end. The value did go up and down, but instead of recognizing those years when it increased as revenue or as investment revenue or some other type of revenue, and recognizing expense in the years in which the fair value went down, those are deferred and never, if things work out as they're supposed to, ever reported as revenue or expense, because they never actually resulted in the government acquiring any resources or sacrificing any resources during that period. They all end up washing out over the 6 years of the derivative instrument. And then the other example, and Becky touched upon this by pointing out that the other pension and OPEB related deferrals tend to have both a deferred outflow balance and a deferred inflow balance at any given time. But for the differences between projected and actual investment returns, the government is going to report the net amount, either the net amount by which actual investment returns exceeded what was projected, or the net amount by which they fell short of what was projected. And just to give you a sense of what this means, without getting deeply into what's involved in measuring pension liabilities and pension expense, the measurement of the pension liability assumes a long-term rate of return on the assets that are in the plan that are being invested long-term. And so when an actuary determines how much the government is going to need to contribute to that plan every year to make sure there are sufficient assets to pay benefits in the future, part of that is allayed by the fact that the earnings of the plan, help to build up assets in the plan as well. But in any given year, the actual earnings on those investments are likely to be either more than what was assumed or less than what was assumed. And so if you look at this table here, you can see in the first year, 2023, the expected earnings minus the actual earnings, they earned more in that year they earned less in that year than they were expecting if they based it on the assumption, whereas in the next year they earn more. And then the year after that, they earn less. And the year after that, they earn more. In this example, it goes back and forth. But rather than reporting, investment revenue in that full amount, because it's likely to offset over time, and therefore not result in the long run in the government acquiring all of those inflows or losing, all of those outflows. Only the net amount gets reported. And so, look, for example, in 2024 here, when there was it looks like a negative number, but this means that the actual earnings were greater than what was expected by 25,000. But the deferral that is reported in that year, and what ends up happening to pension or OPEB expense in that year is much smaller. It's only 1,800, or these numbers are probably in thousands, so it's 1.8 million. You're only seeing the impact on the pension or OPEB expense of the net amount over time and not the full gross amount in any given year. And similarly, in 2026, there is a $35 million earnings above what was projected. But in that year, because you're looking at just the net amounts over time, there is actually only an impact on the pension or OPEB expense, offsetting it by 952,000 rather than the entire 35,000 amount. So that rather than grossly stating these numbers each year, which would really overstate what the government is going to realize over time, you only are looking at the net amounts for each of those years. I realize this is incredibly confusing, and we could probably do an entire 2-hour webinar just on pension and OPEB related deferrals. But the idea here is that this is the type of deferral that's making sure not only that expenses are reported in the proper year, but also that they're only really recognized in the amounts that are going to be realized by the government, and not counting those amounts that end up offsetting one another over time.
And to put it a little more simply, this is basically representing what the actuaries call a smoothing effect, because they know that the market goes up and down in any given period of time. So that's why, they carry it over the 5-year smoothing period, so to speak, to handle that.
Yeah, I try to avoid using the word smoothing because I'm still sensitive to when everybody knew what that meant.
Yes.
in the old pension standards before these ones that require the deferrals. Although I suppose we're far enough along now, it's been at least 10 years since those standards were issued, that I can probably use the word smoothing again and not worry that anybody's going to confuse it with what smoothing meant under the old standards.
All right.
So we have a poll question, Rob.
Excellent. Let me launch this one. Number 6 is coming up. So polling question number 6 asks, which of the following pension-related deferrals should be reported as a net amount rather than as both deferred outflows and deferred inflows? So which should be reported net? Is it A, the differences between projected and actual earnings on plan investments? B, changes in assumptions? C, experience gains and losses? D, changes in benefit terms. So Dean, whilst people take a shot at this question and get their answers in, is now a good time for you to cover any remaining Q&As that have come in?
Sure. There was another one related to the property taxes levied in advance. The question was about taxes being deferred when they're not received until the current year. Sounded confusing. The flow has not occurred, so why is it being reported as deferred? So there is a flow. Flows are not just cash. Other types of resources flow into the government. And the accounting rules for property taxes say that when a government has what's called an enforceable legal claim to the property taxes, at that point, it can recognize property taxes receivable and property tax revenue. And the reason why when property taxes are levied this year for the following fiscal year that you report a deferred inflow rather than revenue is because the government has an enforceable legal claim, in this example, when it levies the property taxes this year. And so it's going to recognize a property tax receivable, but because it's next year's property taxes, you don't want to recognize the revenue side of this until we get to next year. And so until next year has arrived, you report a deferred inflow. And when January 1 or July 1, whenever the fiscal year begins, arrives, at that point, you get rid of the deferred inflow and you recognize the property tax revenue. So the flow that has occurred is the reporting of the property taxes receivable. That's a resource that has flowed into the government. It's not cash. Cash will subsequently come in as payments are made and the receivable gets reduced. But that is a resource inflow, just like a payment of cash is a resource inflow.
Excellent, Dean, and excellent questions. So please do keep them coming in if anyone has any additional questions. We are almost fully answered on this question. Most people have answered. So I'm just going to give people a couple more seconds. So if you're debating your answer, let's get it in now and get your credit. So going once, going twice, I am ending this polling question 6. And Dean, there are the results.
So most people got it right. I don't think we used the phrase experience gains and losses before, which probably should have been included. That's not the right answer. But if you're wondering what that is, the deferrals that are related to differences between projected demographic and economic factors that go into measuring the liability and what actually happened in any given year, those are referred to as experience gains and losses. So like the assumption of a certain return on the investments of the plan is a part of measuring the liability, the actuary is also going to make assumptions about how long people are going to live, what they're going to be earning at the time they retire, and other factors that help to determine the amount of pension benefits that they're going to receive in the future, which then determines how big the liability is that governments have to report in their financial statements. So up to this point, we've talked about what deferrals are, which I hope that you found understandable. We then talked about some of the specific deferrals and how they work. And now I want to talk about what this information looks like when you see it in the financial statements and what it means and what value it provides to the user of the financial statements. So governments are required to present deferred outflows of resources in their own section in the financial statements with their own subtotal following the asset section. They shouldn't be aggregated together with the assets. They should be in their own section. And likewise, deferred inflows of resources should have their own section of the financial statement with their own subtotal following the liability section and not aggregated together with the liabilities. Governments are required to present information about deferrals by type of deferral, like the types of deferrals we've been talking about so far. And they can do that either right on the face of the financial statements, or they can present an aggregated amount in the financial statements, just the subtotal for deferred outflows or the subtotal for deferred inflows, and then show the amounts by type of deferral in notes to financial statements. When you're looking at a balance sheet or a statement of net position, you may see governments that present another subtotal for assets plus outflows, deferred outflows of resources, and liabilities plus deferred inflows of resources. That's optional. Governments are not required to do that, but if they want to, they can. As long as there are separate subtotals for assets, deferred outflows of resources, liabilities, and deferred inflows of resources, these additional subtotals are perfectly acceptable. So this is an example of what the top half of a government-wide statement of net position might look like. And you can see in this example, this government is just showing the total deferred outflows of resources amount, which means that in their notes, they're going to present a disclosure that breaks that total out by the types of individual types of deferred outflows of resources. And that's what this deferral note might look like, where you could see a total that should match what we just saw in the financial statements, and then the individual types for pensions, for OPEB. There are some for derivative instruments in this example. You can see a deferred outflow for loss on refunding of debt and a deferred inflow for a gain on refunding of debt on the other side. This is an example of a governmental funds balance sheet, where you can see in this example, they've also reported an aggregated amount for deferred inflows of resources, which means you're going to see a note disclosure that breaks that out by type of deferral. You might notice that there are no deferred outflows in this balance sheet. Those are relatively rare for the governmental funds. If a government has a governmental fund that is a revolving loan fund, like maybe a fund that provides loans for environmental projects that are cleaning up water sources, then there are some loan-related deferred outflows that you might see in the balance sheet. But otherwise, I can't, off the top of my head, think of any other deferred outflows that are reported in the governmental funds balance sheet. So most of the time, you're only going to see deferred inflows here. And here is the accompanying disclosure that goes with that balance sheet, where you can see all the deferred inflows of resources that were aggregated in that single subtotal line shown by type of deferred inflow. And here, just for your benefit, an example of a statement of net position, the top of it anyway, where you can see deferred outflows shown by type right on the face. So this government wouldn't have to present a note disclosure. And you can see there's deferred outflows related to debt refunding here. So they had an economic loss. And you can see pension and OPEB related. In this example, they have an asset retirement obligation. Perhaps they had a nuclear power plant that has to follow certain procedures when it's retired at the end of its useful life, or some other asset retirement obligation of that source, and there are deferred outflows that are associated with that. And then this is the bottom of that statement, and you can see that the deferred inflows are disaggregated by type right there on the face of the financial statements. And an example for a governmental funds balance sheet where the deferred inflows are shown separately on the face, and you can see that they have two types of deferred inflows here, both of them unavailable revenues, one for property taxes and one for long-term receivables. So we've talked, at great length here about what deferrals are, how governments are required to report them, the different types of deferrals, at least the more common ones that they're required to report. And you can ask, well, is there any value to doing this? We've said that it's important to identifying the right periods for revenue and expense to be reported. We've said some of these deferrals are important for making sure that revenues and expenses are not overstated or understated in any given year. But what can you do with this information once you get it? Well, at a minimum, if you want to just ignore them when you're using the financial statements, I wouldn't recommend that, but you could, and it wouldn't do you any harm. So the value of separating them from the assets and liabilities as GASB initially required is accomplished, but it's not going to minimize the usefulness of the rest of the information to you for whatever purpose you want to use it for. I do recommend that you look at this information because I think it tells you a lot of very important things. For instance, it avoids the possibility of misinterpreting these items as if they were assets and liabilities, as if they were resources that a government could use or obligations that a government is going to have to satisfy. So we talked earlier about this thing that was called deferred revenue before GASB introduced the concepts of deferrals, and how that was an aggregation of both liabilities and future revenues and unavailable revenue as well. And so if you look at the same government, both before deferrals were required to be reported and after, in the before, you can see this deferred revenue line. And in the after deferrals are removed from that amount, you can see what is left of the liabilities that were reported in the deferred revenue amount. And those amounts are except for the capital projects, noticeably different from the total liability reported above. The total liabilities in the general fund before deferrals were almost 7.8 million. And after deferrals are removed from the liabilities, it's just 3.5 million. That's less than half of the amount that was reported there. So the liability amounts are considerably different after the deferrals, and moving them out so that they're not viewed as amounts that would have to be sacrificed by the government. In this version before deferrals were required, where it's almost $7.8 million in liabilities for the general fund, that's a significant overstatement of the resources that the government is going to have to use in the general fund in order to satisfy its obligations. And you can see here that the only thing in that deferred revenue line that actually is a liability is this 1.4 million advance on grants, which is money that this government has that it received before it met the eligibility requirements on the grant. And if it never meets those eligibility requirements, it needs to return this 1.4 million to the grantor. All the rest of what is in that deferred revenue line on the top was actually deferred inflows, unavailable revenue, not a liability. So before we go on and look at some of the other valuable uses for this information, we have another poll question.
Thank you, Dean. I'm launching polling question number 7. This one asks, if a government shows only a total for deferred inflows in its balance sheet, how is it required to report deferred inflows by type? So is it in a separate financial statement, in a separate regulatory report, in required supplementary information, or in the notes to the financial statements? And Dean, just to kind of piggyback what you were talking about there, when we talk about ignoring deferred inflows and outflows, certainly your auditors, if you do choose to ignore them, your auditors may have a difference of opinion there and feel that if there's material items misclassified, that they might give you audit issues. So got to weigh up and consult probably with your auditors, your approach to doing that. But certainly be careful.
Just to be clear, Rob, yeah. I wasn't suggesting that governments ignore them. Governments are required to report them when they're material. From the perspective of the user of the financial statements, you could probably continue to do whatever it is you do with financial statement information while ignoring the deferral amounts that are there. So I was talking about what you could do as a user of the financial statements, but I hope that no one thought that I was suggesting that governments could just ignore them. Governments are required to report them. So,
well, I appreciate you clarifying that, and yeah, certainly want to make sure that people heard it that way, and just double check that. Yeah, certainly, yeah, don't want to do any non-compliance with GAAP.
I did want to ask Becky a question, because I was just talking about the options here in terms of presenting them by type on the face or in the notes. Whether, Becky, your experience has been that a lot of governments show them individually on the face of the financial statements, but the bigger the government gets and the more likely it is to have deferrals, or the more types of deferrals it has, the more likely it is that you're going to see a single line on the face and the disaggregation in the notes instead.
Yeah, and I think we've seen largely that folks are disaggregating, but now that we're adding, leases into the puzzle, and if they have the 3 Ps, and as these numbers lines are getting longer and longer, I think I'm personally going to suggest to my clients to go ahead and go to a single line item and move it to the back, because I think it makes the statements a lot easier to read. It doesn't make them, the font smaller, and I think it's going to be a good idea to make some of those changes to make it a little easier for the user of the financial statements to be able to read it more clearly.
Mm-hmm. And no one should think that this is a special thing for deferrals. There are several things on the face of the financial statements that require a certain level of detail that governments can satisfy either on the face of the financial statements or in the notes. Capital assets is one example where they can show it aggregated on the face and then show the detail in the notes. Long-term liabilities often are aggregated on the face of the financial statements, and then the required detail by type of long-term liability is shown in the notes instead.
Yeah, and it's certainly a decision that each entity needs to look at and make in regards to, how many line items does it have in its financial statements? How does that affect the readability of their financial statements, and what makes the most sense for each entity?
Excellent stuff. And I'm going to move us on here and just give the last couple of seconds on the question. We are very close on wrapping up on time. So get your answers in. Last chance on polling question 7. Going once, going twice, ending that poll and sharing the results. Dean, is it back to you or Becky for the last little bit?
Back to me. So most people got that right. It's in the notes to the financial statements if it's not on the face. So another thing that's really valuable about deferral information, it stems from the way it helps you to avoid misinterpreting them as assets or liabilities. And that's that it helps you to get more accurate financial ratios if they contain information about assets or liabilities in them. So just picking one common type, what are called leverage ratios, which help you to understand the degree to which a government has borrowed in order to acquire the assets that it has. In its simplest form, that ratio is liabilities divided by assets. So if we use the information from that slide where I showed you before and after deferrals, before deferrals, with that larger liability number of almost 7.8 million, the leverage ratio is 82%, which is pretty high. That's, 8 out of $10 worth of their assets were acquired by borrowing of some sort, either issuing debt or purchasing things on account or some other manner in which they borrowed over the longer term in order to acquire those assets. And generally speaking, all other things being equal, the less leveraged a government is, the lower this leverage ratio is, the better off it is financially. And if you look at the same ratio after deferrals are required, when all those things that really were unavailable revenue were removed from the liabilities in that financial statement, their leverage ratio is less than half of what it was looking at the pre-deferrals information. In this post deferrals example, their leverage ratio is just 37%, which is a lot healthier looking than a leverage ratio of 82%. Another use that could be valuable to financial statement users from deferrals is taking a look at unavailable revenue over time as a reflection of a government's ability to collect payment on its receivables. So if you were to look at an 8-year period, for instance, and track the amount that's being reported as unavailable revenue, in this example, unavailable revenue related to grants, and then look at each year's grant revenues and create a ratio out of that, the resulting ratio is sort of giving an indication of how much of their expected grant revenue they still haven't collected, beyond the period of availability after the end of the fiscal year. And the bigger that amount is, the longer it's taking them to collect on their on this particular receivable. And these seem like relatively high numbers to me. I didn't go back and calculate them for a lot of other governments to get some point of comparison, but they're in the range of half of their expected revenues. They still haven't an amount that's equivalent to half of their annual revenues still remains uncollected as of the end of the year related to their grants. And then something happens in this government. I was thrilled that I happened to pick this one randomly because something weird just happened here. What happened in 2019? Why did it go from nearly half to zero? What happened to their unavailable revenues for grants in that year? I don't know. But that's, if you're a financial statement user and you see something like this, it's obviously something you're going to want to follow up with the government. If you can't find an answer to it in the financial statements themselves, some explanation as to what happened here. I suspect that they may have changed their period of availability, that this government may have lengthened it. Maybe it was 60 days and they changed it to 120 or 180 days in order to be able to report a larger amount as revenue in the governmental funds than they were reporting before. The deferrals that are related to pensions and OPEB can be really useful. If you compare what you're seeing in those notes, the examples of which Becky showed, with the schedules that governments are required to present as required supplementary information that show how the pension and OPEB liabilities have changed over an extended period. So this is what a typical pension schedule would look like in RSI. It's only got 8 years because governments are building this up prospectively over time, and it's only been 8 years since they first implemented these pension standards and started reporting this information. But what this schedule does is it shows all the things that contribute to increases and decreases in the pension liability from year to year. And it basically explains why the pension liability grows or decreases over time. And you can see, looking at the total liability, the net pension liability that's being reported in the financial statements, that number grew pretty steadily from 2015 to 2021, but then dropped off significantly from 210, almost 211 million to a little less than 166 million. So it dropped by about $45 million in 1 year. And if you look at the explanations above, the things that changed from 21 to 22, the most significant change, and the thing that explains all of the decrease, is that they had a substantial increase from 1 year to the next in their net investment income, the earnings on the investments of the plan. And if you look at that over the 8 years here, you can see what we were talking about before, where the measurement of the liability assumes a long-term rate of return, but in any year, the actual returns are less or more. And this happens to be a year where it was significantly greater than what was assumed in the measurement of the liability. So if you then go and look at the deferral disclosures for those years, for 21 and 22, you can see that in 21, there was a deferred outflow of resources related to the difference between projected and actual earnings on plan investments, which means that net over time, they were $16 million short of the projected earnings in terms of what they actually earned. But those earnings in that 1 year were so significant that it moved them from a deferred outflow of resources to a net deferred inflow of resources twice as large. And so now in the second year, as a result of those significant earnings, they now have a net deferred inflow of resources of over $37 million. And if you then look at how that translates into what's expected to become pension expense over the next 5 years, by comparing what it was last year when it was a deferred inflow to what it is, deferred outflow, sorry, to what it is now as a deferred inflow. For 2023, there was an expectation that the deferrals were going to add over $13 million to pension expense. But as a result of that change and changes in other deferred inflows and outflows related to pensions as well, 2023, they're now expecting only to add $306,000 to pension expense in that year rather than $13.3 million. And the same is true in these other years as well, where it actually goes from an expectation that there will be net additions to pension expense, that they will actually be reductions in pension expense over the next several years rather than significant increases. And then lastly, the derivative instrument related deferrals will help to indicate to you the danger of the government being exposed to a loss, or on the flip side, the possibility of a gain if that hedge shouldn't make it to its full maturity, if it becomes ineffective or something else happens to terminate it before it runs its full course. And so if you look at the disclosures and compare 2 years, so looking at 2021, governments are required to disclose their deferrals by type. And you can see here the interest rate swap example that I was talking about before. In 2021, they have a deferred outflow of $14 million, which means if this terminated right then, that government could be on the hook for a $14 million payment to the counterparty to that transaction. And in the next year, it had grown by over 50% to over $21 million. So their exposure to risk here, their potential for having to make a payment if that hedge doesn't continue to effectively offset its losses, has grown from 1 year to the next. And then lastly, Becky was talking before about the use of deferrals for these longer term transactions like leases and P3s and service concession arrangements, where governments might receive significant payments up front. Looking at those over time will give you some sense of how those deferrals will end up contributing to a government's interperiod equity over the length of the transaction. So if you look in the disclosures of the deferrals, in this particular example, you can see this government has a public-private partnership. It also has a service concession arrangement, both of which have deferred inflows of some significance, 106 million and 28 million of whatever has not yet been recognized as revenue from their upfront payments. And if you happen to know the number of years that are remaining on those arrangements, on that P3 and that SCA, you can divide that deferred inflow by the number of remaining years, and that gives you an indication of how much you can expect that government, in round terms, how much they're going to recognize as revenue, and what's going to contribute to their interperiod equity in each of those years, based upon the spreading of the recognition of the revenue over the life of the transaction, rather than recognizing it all up front when the upfront payment is made. So I think this is our last poll question, and then we're wrapping things up.
Excellent, Dean. Thank you very much. I'm launching polling question number 8. Oops. I think I clicked that one too many times. So
I can see the poll question on the screen.
yeah, I don't think anyone's going to be able to answer. I think I double clicked. Let's hope everyone got their earlier questions in. I apologize for that, and I'm not aware of any way that I can fix this. Let me just try quickly. No, I think unfortunately. Let me see if I can relaunch. There is an option to relaunch. Relaunch poll. Oh, there we go. Oof. Sorry about that. Bit of drama at the end, everyone. I apologize, and I know we're.
Thanks. You just gave heart attacks to all the people online.
Yeah, everyone who only had 5 answers in, and we needed this one for their credit, so I apologize. So let me read this one out. Back on track. Okay, this one asks, which of the following is not a way in which deferrals are valuable? Avoids overstating assets and liabilities, makes financial ratios more accurate, projects future debt issuances, supports assessing whether whether a government has lived within its means. I'm going to keep my finger well away from the end poll button just for a moment. Dean, I know we are short on time, but I've seen a couple of Q&As come in. Do you want to take a swing at any of those Q&As right now, or maybe we follow up with the people who've asked them after the session? What do you think, Dean? Do you want to take a shot?
I think I can bang them out pretty quickly. There's one question here about what's the difference between accruals and deferrals. Accruals are, that's when you're reporting, amounts in the financial statements. Deferrals are a postponement of the accrual of the revenues or expenses or expenditures. So, when, for instance, when inflows or outflows are related to the current period, you're going to accrue revenue or recognize revenue or expense. The difference when they're related to future periods is that you're initially going to report the inflow or outflow as a deferral and wait until that future period before you actually report the accrual for the revenue or the expense. And then the other question here was, can you go over multi-year grants and the deferral of unearned portion? Well, that multi-year grants don't have unearned portions because you never earn grants, but you do meet eligibility requirements. And as long as there are eligibility requirements, a government is, if it has received grant payments in advance, it's going to be recognizing a liability because if it never meets those eligibility requirements, it has to pay them back. On the other hand, if there are no eligibility requirements or they've been met, and the only thing that remains is a time requirement, the government can't use it until some future period. That's when you're going to report a deferred inflow. And when that future period arrives, you get rid of the deferred inflow and you can recognize the revenue for the grant.
Fantastic, Dean. Thank you for taking care of those. And I'm going to wrap this one up here in the next couple of seconds. So last chance to get your answers into polling question number 8.
Yeah, well, now that I've already put the answer up, I think everybody who's answered is probably in there by now.
Yep. So going once, going twice, ending the poll properly this time, sharing the results. And Dean, how did people do?
Most people got it right that it doesn't project future debt issuances. The deferral information, however, can be used for those other 3 purposes. So we just want to wrap up with a couple of things. One, to talk about some of the other things that we're doing at CRI related to educating the public about deferrals connected with this webinar. Rob mentioned this very briefly in the beginning. Following this webinar, sometime in the next week, a recording will be made available for you to rewatch if you're a glutton for punishment, or if for people who didn't have a chance to attend the live webinar recording. The webinar slide deck will be available as well. Sometime in the next week or two, a short follow-up article will be posted to our website. We'll notify you about it. That I think is called Deferrals in a Nutshell. That covers deferrals at a very high level in plain language. And then we are in the process of preparing several other resources that will be available over the next month or so for anyone in the public to use free of charge. One will be a longer plain language article that essentially covers the same ground as the webinar, but in a written form rather than in a presentation. We've created a more technical slide deck for the accountants and auditors out there who really want to get into the specific requirements and the related standards and what the debits and credits are. And we've also written an article from the perspective of a financial statement user and how they can interpret the information about deferrals and how that contributes to their use of financial statement information to make decisions or analyze government financial health or hold governments accountable. And many of those we're going to combine into an electronic book that we're going to make available to the entire public, but provide free of charge for use in undergraduate and graduate accounting courses, governmental accounting courses, any course in which they deal with governmental accounting where they might want some help in explaining what deferrals are. This is part of a larger effort on the part of Carr, and Ingram to help clear away some of the fog that tends to descend when anybody mentions the word deferrals. So excellent. Just wrapping things up, no one doubts that deferrals can be difficult to understand conceptually. I hope that everyone comes away from this with a little bit better, if not a more complete understanding of what deferrals are, and understanding that they are revenues or expenses that are going to be reported in some future period, if at all, and that we're waiting for that future period to happen. And that's the thing that differentiates them from what inflows that are being reported as revenues and outflows that are being reported as expenses and expenditures. No matter how hard you wish that deferrals are going away, they're not. There's no indication that GASB is going to change their path. There isn't anything in their agenda right now that looks like it might add more deferrals, but the ones that exist are not going to go away. And why would you want them to? We know that these things are not assets and liabilities, and it's hard to imagine why we would want to pretend that they are assets and liabilities. Deferrals are very important to the assessment of interperiod equity, whether government is living within its means from year to year. And there are a lot of ways that you can use that information to evaluate that. And there are several other really valuable uses for this information as well.
And remember, deferrals are just simply reporting of timing differences, not recognition differences. So if you can kind of remember that in your thought process, it'll be a little easier for you to grasp the concept. Also, don't confuse deferrals with true assets and liabilities. And remember that there are numerous types of deferrals, each with different requirements on how to be accounted for. So if you run across one, seek guidance with the standards.
Well, I think we've addressed all the questions, so I will wrap up here. And I just want to thank everyone for their time listening today. I hope you took a lot from it. And as Dean said, this is a big, complicated subject. So we do have a lot more information to come and guidance to provide. So everyone who's registered for this class will get links and be made aware when those additional resources are available. Last thing I'll say is that in addition to deferrals, CRI does a number of CPE webinars specific to governments. We typically do one a quarter, so stay tuned and check out what our next one is that we have coming up. It's not currently on the calendars, but it will be soon. So do keep an eye on that and follow what we're doing at cricpa.com. And with that, we're going to wrap up here and just thank you all again for attending. And I hope you all have a good rest of your week. Bye-bye.